The billionaires are selling, and they are doing it at an unprecedented scale. Between February and November 2024, the wealthiest people on the planet collectively sold over $50 billion in stocks. We're talking about Jeff Bezos selling $13 billion of Amazon stock, Mark Zuckerberg offloading over $9 billion of Meta, and Jamie Dimon, the CEO of JP Morgan Chase, selling for the first time in his entire 18-year tenure. Even the Walton family, heirs to Walmart, sold more than $2 billion in stock. If you think this is normal, it's not. These are not just wealthy individuals moving their portfolios around. They're moving massive amounts of wealth out of the market. But this is only the beginning of a much bigger picture. These moves are not about estate planning or tax optimization. They're warning signs, the kind of warning signs you should pay attention to, because what they're seeing right now is something catastrophic. The world's smartest money is preparing for a major crash, a financial collapse, one that's eerily similar to what we saw in 2008. Let me tell you why this matters. This isn't just about stock prices or market crashes. This is about real people, the ones who had no clue what was coming in 2007 when they saw their life savings evaporate overnight. It's about understanding the hidden patterns that predict major economic events. You see, insiders, those with intimate knowledge of the companies they run, are the ones who really know what's happening beneath the surface. Jeff Bezos doesn't just see Amazon's quarterly earnings report. He sees the daily sales numbers, the margin trends, the competitive pressures, the internal forecasts. He knows what's coming down the pipeline months before it hits the public eye. The same goes for Zuckerberg. He knows Meta's real engagement numbers, not the public-facing ones. Jamie Dimon has a front-row seat to the inner workings of the global financial system. He sees loan defaults in real time. And trust me, when he's selling his shares, it's not because he's trying to diversify his portfolio. These are the guys who've lived through crashes. Bezos survived the dot-com crash, the 2008 financial crisis, and the pandemic's economic downturn. But now, for the first time ever, he's moving significant chunks of his Amazon holdings. Same goes for Zuckerberg. For someone who's tied so heavily to his company's stock, selling billions at this scale is a serious red flag. And then there's Dimon, who, for 18 years, has held on to his JP Morgan stock, preaching about long-term investment. But now, he's selling. When the biggest names in the game start pulling out, it's time to pay attention. This isn't a normal cycle of wealth redistribution. This is a coordinated exodus. The smart money is running for the exits. But what are they seeing? What do they know that the average investor doesn't? Why are they pulling out at this scale? To understand this, we need to look at the data, the patterns of insider selling, and how these patterns predict the coming financial crisis. Insiders like Bezos and Zuckerberg are not making these moves on a whim. They are driven by something far more substantial. We can call it pattern recognition. They know the market is about to hit a critical juncture, and they are positioning themselves before the inevitable crash happens. The data tells a story that every investor should hear, especially if they're planning to stick their money in the market for the next few years. And this isn't just about hindsight. We have historical patterns that show this kind of insider selling precedes a major downturn. This is where the danger lies and where opportunity can arise for those who position themselves early. Now, let's talk about the patterns. Every major market crash in recent history has been preceded by a significant increase in insider selling. The data doesn't lie. Insiders, those with the most privileged information about their companies, sell before the rest of us see the warning signs. In fact, these sales are the first red flags that signal trouble ahead. In 1987, before the market crash that took everyone by surprise, insider selling spiked by over 350%. This was the same year that the market hit its peak in August, only to collapse in October. Insiders knew the party was about to end. They saw the signs, the same signs that are becoming clearer today. They sold off their stock long before anyone else noticed that something was wrong. By the time the crash hit, they were already sitting in cash, waiting to buy back in at the bottom. In 2000, during the dot-com bubble, insider selling hit record levels just before the market collapsed. The Nasdaq peaked in March 2000 and then fell by a staggering 78% over the next 2 years. Just like in 1987, insiders were ahead of the curve. They sold their shares while the market was still booming, only to watch as retail investors and institutions continued to pour money in. The crash that followed was brutal, but the insiders who sold at the top were able to buy back in at much lower prices, emerging wealthier than before. And then there's 2007, the year before the global financial crisis. Insider selling in 2007 hit an all-time high of $650 billion. That was the year when the S&P 500 peaked. and soon after, it crashed by over 50%. Insiders saw the writing on the wall. They were already getting out of the market, while the rest of the world was still riding high on the housing and financial booms. By the time the crash came, they had already sold, preserving their wealth and preparing to scoop up discounted assets after the collapse. Fast forward to 2024, and we're seeing similar patterns. The insider sell-to-buy ratio has reached an extreme level of 91. In simple terms, insiders are selling $9 for every $1 they're buying. This is the highest ratio we've seen since 2007. Back then, the ratio hit 10-1 before the market took its massive dive. It's not just a coincidence. The pattern is unmistakable. The insiders are sending us a message, and it's one that cannot be ignored. Why is the sell-to-buy ratio so important? Because it's a direct reflection of insider confidence. A healthy ratio is typically around 2 to 3, meaning insiders are usually selling $2 or $3 for every dollar they buy. This is normal. Executives sell some of their stock for personal reasons, taxes, estate planning, or diversification. But when the ratio skyrockets to levels above 50, it's a warning. Above 80, it's an alarm bell. And in 2024, we're seeing an even more extreme imbalance. Insiders are getting out, and you should be asking yourself why. The reason they're selling isn't just about personal finances or diversifying their portfolios. It's about seeing something bigger on the horizon. They have access to the most accurate and up-to-date data on their companies. And when they see trouble brewing, they don't wait. They act. They know that when things start to turn, it's better to be in cash than holding onto overvalued stocks that are about to crash. What's particularly concerning about 2024 is that we're not just seeing this in one sector, but across multiple industries. Tech is at the top of the list. Companies like Amazon, Meta, and Nvidia are all experiencing significant insider selling. Why? Because these companies are riding the wave of the AI boom, and valuations are sky high. The growth expectations are so high that they're almost impossible to sustain. Insiders know this. They're cashing out while the stock prices are still elevated. When the crash happens, they'll be sitting on cash, ready to buy back in at lower prices. The financial sector is also in the spotlight. We've seen Jamie Dimon, the CEO of JP Chase, sell off his stock for the first time in nearly 2 decades. This is a huge red flag. Dimon has always been a strong proponent of long-term ownership, and for him to sell now speaks volumes about what's coming. He knows what's happening behind the scenes in the financial system. Loan defaults, rising delinquencies, and mounting losses in commercial real estate. These are the factors he sees every day at JP, and they're not looking good. What's even more concerning is the broader economic picture. The market is being propped up by artificially high levels of debt, corporate debt, government debt, margin debt. It's all at dangerous levels. Margin debt in particular has hit near record highs, with investors borrowing more and more money to buy stocks. This kind of leverage is a double-edged sword. It amplifies gains when the market is rising, but when the market falls, it forces people to sell to cover their loans. This creates a vicious cycle of forced selling that accelerates the market's decline. But the insiders see all of this coming. They know that when the market turns, it's going to be a bloodbath. They've seen it before, and they're positioning themselves accordingly. They're selling now, so they can buy back in at lower prices after the crash. And when the dust settles, they'll be in a much stronger position than those who held on too long. The patterns of insider selling and the warnings we're seeing right now are not coincidental. In fact, there are historical cycles that suggest we are nearing a major market collapse. These cycles have repeated themselves time and time again. The tech bubble of the late 1,990 seconds, the housing bubble that led to the 2008 crash, and now the tech bubble surrounding AI and other high-growth sectors. What makes this situation particularly alarming is the convergence of multiple risk factors. Insider selling is just one of the many signs that indicate the market is on the brink of a major correction. We also have the Buffett indicator, the Shiller PE ratio, margin debt, corporate debt, and commercial real estate, all of which are signaling that the market is dangerously overvalued. Let's start with the Buffett indicator. This is Warren Buffett's preferred measure of market valuation, and it's currently at an all-time high. The Buffett indicator is the total market capitalization of all U.S. stocks divided by GDP. Historically, when this ratio exceeds 100%, it's considered a warning sign of overvaluation. Right now, that ratio sits at around 185%, which is nearly double the historical average. This tells us that the stock market is valued at more than double the entire U.S. economy's output, For this overvaluation to make sense, you'd have to believe that the economy will grow by 50% over the next few years while the stock market remains flat. Or you'd have to believe that corporate profit margins will continue to soar to unsustainable levels. Neither of these scenarios is realistic. In fact, the opposite is more likely. We'll see slower economic growth, and corporate profit margins will begin to compress as inflation takes its toll and demand slows. The Shiller P/E ratio, which adjusts for inflation, is another key indicator of market overvaluation. The historical average for the Shiller P/E is around 16 or 17. Above 25 is considered expensive, and above 30 is in bubble territory. Right now, the Shiller P/E stands at 34, which is higher than it was in 1929, just before the Great Depression. It was also higher in 2000, just before the dot-com crash. Every time the Shiller P/E has exceeded 30, the market has experienced a major downturn. In 1929, it crashed by 89%. In 2000, it fell by 78%. And in 2008, when the market was at similarly inflated levels, it dropped by 57%. We're seeing the same signs today, and the smart money is already selling. The billionaires who are pulling their money out of the stock market are doing so because they see the writing on the wall. They know that when the market crashes, it's not just going to correct a few percentage points, it's going to crash hard. Another key factor contributing to this overvaluation is margin debt. When the market is rising, investors are more willing to borrow money to buy stocks. This amplifies both gains and losses. Right now, margin debt is at near record highs, with investors borrowing nearly $950 billion to buy stocks. This is dangerous because when the market turns, investors who are heavily leveraged will be forced to sell to cover their loans. This forced selling creates a cascade of liquidation, further driving down stock prices. Just look at what happened in 2008. When the market crashed, margin debt collapsed from $850 billion to $280 billion in just 18 months. This forced selling accelerated the decline, pushing stocks down even further. And we're at similar levels of margin debt now. When the market begins to fall, it will trigger a new wave of forced selling, and it will happen quickly. But the dangers don't stop there. We're also facing a major corporate debt crisis. U.S. companies owe $13.5 trillion in corporate debt, much of it issued during the low interest rate environment of 2009 to 2021. Now that interest rates are rising, many of these companies are struggling to refinance their debt at higher rates. The cost of borrowing has skyrocketed, and many companies simply can't afford to service their debt. This is already leading to a rise in corporate bankruptcies. Bed Bath & Beyond, Party City, Rite Aid, and Silicon Valley Bank are just a few examples of companies that have already defaulted, and the wave of defaults is just getting started. Over the next few years, $4.7 trillion in corporate bonds will mature, and if just 10% of these companies default, that's $470 billion in losses. These defaults will hit bondholders hard, leading to further market turmoil. As companies default, their stock prices will plummet, and this will cascade through the market. The final piece of the puzzle is commercial real estate. Office buildings, which were once seen as a safe investment, are now sitting 40 to 50% vacant due to the shift to permanent remote work. Buildings purchased at peak prices with low-interest mortgages are now worth 40% less. As these mortgages come due, property owners will be forced to refinance at much higher rates. Many of them won't be able to do so, and we could see a wave of defaults in the commercial real estate sector. This is the perfect storm. The stock market is overvalued, margin debt is at record highs, corporate debt is unsustainable, and the commercial real estate market is in free fall. The insiders who are selling now know all of this. They have access to the data that shows what's coming, and they're getting out before it hits. They're positioning themselves to survive the crash and even profit from it. So, what can you do about all this? How do you prepare for the inevitable market collapse that insiders are clearly anticipating? First, let's talk about positioning. The key to surviving and even thriving during a financial crash is to reduce your exposure to the stock market and raise cash. When insiders are selling, you should be doing the opposite of what most retail investors are doing. Instead of chasing the market higher, you need to start thinking about how to protect your wealth. Reducing your equity exposure means selling off some of the stocks that have risen to unsustainable levels. The smart move is to lighten your portfolio of overvalued tech stocks, especially those in the AI sector, and focus on quality companies with strong balance sheets and consistent earnings. Think of companies like Apple, Microsoft, Visa, and Costco, companies that have a history of weathering economic storms. These are the types of stocks that will rebound more quickly after the crash and will offer you more stability when everything else is crumbling. But cash isn't just for sitting on the sidelines, it's your dry powder. When the market crashes, cash will become your most powerful tool. As stock prices fall, you'll be able to pick up quality assets at a fraction of their peak prices. Remember, wealth is built during times of crisis, not during periods of prosperity. When everyone else is panicking and selling off their stocks, that's when you'll want to deploy your cash. But cash is only part of the equation. Another important asset to consider is gold. Historically, gold has been a hedge against economic instability and inflation. As we approach the next financial crisis, gold will likely surge in value. During the 2008 crisis, gold increased by over 25% as investors flocked to safe haven assets. In 2020, when the COVID-19 pandemic sent shockwaves through the global economy, gold rose by 25% again. If history repeats itself, gold could be one of the best ways to protect your wealth in the coming years. If you don't want to buy physical gold, another option is to invest in the GLD ETF, which tracks the price of gold. Allocating 10-15% of your portfolio to gold is a smart way to diversify and protect yourself from the upcoming volatility. Gold will preserve your purchasing power when the dollar is devalued due to the government's efforts to print more money to bail out the system. It's insurance against a financial meltdown. But there's one more thing you should do, and this might be the most crucial. Create a buy list. If you're like most investors, you've probably been holding on to stocks that have been rising steadily for years, hoping for more gains. But when the market crashes, the focus needs to shift from hoping to buying. You need to be ready to take advantage of the buying opportunities that will present themselves when prices hit rock bottom. This buy list should include companies with strong fundamentals, solid cash flow, and a competitive edge in their respective industries. Think about companies like Johnson & Johnson, which has a strong balance sheet and a history of paying dividends, or Visa, which is a leader in the global payment space. The key is to focus on quality and avoid the temptation to buy speculative stocks that are likely to be decimated during a crash. The beauty of having a buy list ready is that you'll be able to act quickly when the market starts to fall. Panic selling is often the reaction when stocks begin to drop, and the media will be all over it, fueling fear and uncertainty. But if you're prepared, you won't be a part of that panic. You'll be picking up stocks at discounted prices and positioning yourself for the eventual recovery. The worst thing you can do is sit back and wait for the crash to unfold without a plan. If you don't have a plan in place, you'll be swept up in the chaos and end up losing more than you ever should have. Now, I know many of you might be thinking, but what if the market keeps going up? What if I miss out on more gains? That's the fear talking. The truth is, if you're in the market for the long term, you should be more concerned about protecting your wealth than chasing every last dollar of profit. The market may continue to rise for a while, but when it does finally crash, it will likely be a 40-50% decline in a short amount of time. That's the kind of decline that can wipe out years of gains in a matter of months. And if you're not ready, you'll be forced to sell at the worst possible time. So, what's the best course of action? It's simple. Reduce your equity exposure, raise cash, buy gold, and have a list of high-quality stocks ready to pick up when the market hits bottom. The insiders are already ahead of you, selling their stocks at the peak. Don't wait until it's too late to act. But here's the thing. Even if you take these steps, you also need to prepare mentally for what's coming. The media will be all over the crash, and the emotional toll it takes on investors can be overwhelming. You'll see your portfolio value drop by 30, 40, 50%, and it will feel like the end of the world. But you have to stay calm. This is when you buy, not sell. The market will recover, just like it always has, but only if you have the discipline to stick to your plan. It's also important to prepare for the possibility of job loss or income disruption. During a recession, companies will cut jobs, and unemployment could rise to double digits. That's why building an emergency fund with 12 months of living expenses is essential. This cash cushion will help you weather the storm and avoid being forced to sell your investments at the bottom of the market. The goal is to give yourself the financial flexibility to stay calm when everyone else is panicking. When you take the steps to prepare for a market crash, you're not just safeguarding your wealth, you're positioning yourself for future growth. The reality is, crashes don't last forever. They may be devastating in the short term, but they also present incredible opportunities for those who are prepared. The key to building generational wealth is knowing when to step back, preserve your capital, and then jump back into the market when the conditions are right. Let me explain what that means for you. When the market crashes, as it inevitably will, you're going to see prices for high-quality assets like Apple, Microsoft, Johnson & Johnson, and other blue-chip stocks plummet. But here's the secret. Those stocks won't stay down forever. The market is cyclical. It moves in waves, and after every crash comes a recovery. Just look at the aftermath of the 2008 financial crisis. After the market crashed, it took about 6 years for the S&P 500 to hit new highs again. But for those who were able to buy stocks when they were at their lowest, the rewards were enormous. The market doubled in value between 2009 and 2015. If you had bought into companies like Apple, Amazon, and Microsoft at the bottom, you would have seen your investment grow by hundreds of percent. The same opportunity is coming again, and this time the opportunity could be even bigger. However, in order to benefit from this recovery, you need to be in the right mindset. It's not enough to simply have a list of stocks you want to buy. You need to be emotionally prepared for the inevitable volatility. When the crash comes, and it will, the media will be in full panic mode. The headlines will be filled with doom and gloom. Everyone will be talking about how much money they've lost, how the economy is spiraling out of control, and how it's the end of the financial world as we know it. If you don't have the mental fortitude to stick with your plan, you may be tempted to sell at the worst possible time. That's why it's crucial to position yourself psychologically. When the market crashes and you see your portfolio drop by 30, 40, 50%, you can't let fear take over. You can't panic. Instead, you need to keep a level head and remember why you're doing this. This isn't about short-term fluctuations, it's about long-term wealth. You need to trust that when the market recovers, your high-quality stocks will rebound and you'll be able to buy them at a massive discount. But that's not all. It's not just about surviving the crash, it's about thriving after it. When the market hits rock bottom, there will be incredible buying opportunities. Many of the companies you've been eyeing for years will be trading at fire sale prices. Stocks that have been out of reach due to high valuations will suddenly become affordable. You'll be able to buy high-quality companies at a fraction of their true value. And as the market recovers, you'll be sitting pretty with a portfolio of stocks that are primed for growth. Think about companies like Apple, Microsoft, Amazon, and Visa. These are the kinds of companies that are likely to bounce back the quickest after the market hits bottom. These are the stocks that have been tested through multiple market cycles. They've weathered recessions, financial crises, and technological disruptions, and they're still standing strong. When the market crashes, those who are able to buy these companies at discounted prices will see tremendous returns when the market recovers. So here's the bottom line. A market crash is not the end of the world. In fact, for those who are prepared, it's the beginning of a new opportunity. The key is to reduce your exposure to overvalued stocks, raise cash, buy gold, and have a list of high-quality stocks ready to scoop up when prices plummet. If you can stay calm, stay focused, and avoid the panic, you'll be able to buy the best assets at a steep discount, and in the end, you'll come out ahead. But remember, it's not just about the financial side of things. You need to prepare yourself mentally and emotionally for the chaos that will unfold. There's a reason that most investors lose money during a crash. They let fear dictate their decisions. They panic sell when the market is at its lowest point, only to miss out on the recovery. You can't let that happen to you. If you're emotionally prepared, financially positioned, and have a clear plan in place, you'll be able to weather the storm and come out of it stronger than ever. The crash may seem like the end, but it's really just the beginning of a new opportunity. It's up to you to take advantage of it. And remember, the billionaires are already ahead of you. They've sold their stocks at the top, and they're waiting for the market to hit bottom so they can buy back in. They're not going to panic when the market drops. They'll be buying, and you should do the same. The time to act is now. It's easy to feel like an outsider when billionaires and insiders start pulling out of the market. You might wonder, what if I'm making the wrong choice? What if the market keeps going up for another year? The truth is, the market can stay irrational longer than you can stay solvent. But you need to trust in the patterns that have played out time and time again. These billionaires, who have survived countless market cycles, are not panicking. They're making informed decisions based on data, and right now, the data says it's time to get out. What's coming next is not just a market correction, it's a major economic event. We're entering a period of uncertainty, where everything from the stock market to real estate to government debt is being stretched to its breaking point. The market may look strong now, but the signs of strain are everywhere. The indicators I've shared with you, the Buffett indicator, the Shiller PE ratio, margin debt, and insider selling all point to one thing. The market is overvalued and the next crash is inevitable. In fact, the economic pressures we're facing today are even greater than they were in 2007. Back then, it was the housing market that was inflating the economy, and when it burst, it sent shockwaves through the global financial system. Today, we're dealing with an even bigger problem, a global economy that is heavily reliant on debt and cheap money. For over a decade, interest rates were at historic lows, encouraging borrowing and risk-taking. But now, as the Federal Reserve raises rates to combat inflation, the cost of borrowing has skyrocketed. Companies that were once able to finance their growth with cheap debt are now struggling to refinance at higher rates. Some will fail to meet their obligations, and we're already seeing the early signs of corporate defaults. The commercial real estate market is another area of concern. Office buildings that were once considered safe investments are now sitting empty. Remote work has become a permanent fixture in the workforce, and many businesses are reducing their office space requirements. This shift has left a significant portion of the commercial real estate market in a state of crisis. Buildings purchased at peak prices are now worth 40% less. And as mortgage rates rise, property owners are finding it increasingly difficult to refinance their loans. Many will default on their debt, which will trigger a chain reaction of further defaults and falling property values. This is a ticking time bomb that will have a ripple effect on the broader economy. Meanwhile, corporate debt continues to rise. As I mentioned earlier, U.S. companies owe $13.5 trillion in debt, much of it borrowed during the years of low interest rates. But now, as interest rates rise, servicing that debt is becoming more expensive. Many companies that were once able to afford their debt payments are finding themselves in trouble. We're already seeing a rise in corporate bankruptcies, and this trend is expected to accelerate over the next few years. As companies default on their debt, their stock prices will plummet, and the impact will be felt across the entire market. The U.S. government's debt situation is just as dire. The national debt has surpassed $36 trillion, and the annual deficit continues to grow. Interest payments on that debt are now higher than the country's defense spending. This is not sustainable. At some point, the government will have to make hard choices. It will either raise taxes, cut spending, or resort to printing more money. Any of these options will have serious consequences for the economy. If taxes are raised, it could stifle economic growth. If spending is cut, it could lead to a recession. And if the government starts printing more money, it will fuel inflation and devalue the dollar. None of these options are ideal, and they all point to a coming financial crisis. In light of all this, the billionaires who are selling their stocks aren't just making moves to preserve their wealth, they're positioning themselves for the next phase of the economic cycle. They understand that the market will fall, but they also know that it will eventually recover. When it does, they'll be in a better position to profit. They're selling now, while stock prices are at their peak, so they can buy back in at a lower price when the market hits rock bottom. But the truth is, not everyone is in a position to make these moves. Many middle-class investors, especially those approaching retirement, don't have the luxury of time to recover from a market crash. If you're relying on your 401 or retirement savings to support you in the future, a market crash could decimate your nest egg. That's why it's so important to act now. You need to position yourself to survive the crash and protect your wealth. One of the best ways to do that is by reducing your stock exposure and raising cash. If you've been holding on to high-risk stocks for years, now is the time to reevaluate your portfolio. Start by selling off the overvalued stocks in your portfolio and moving into safer assets like gold. Gold is a time-tested hedge against inflation and economic uncertainty, and it has consistently performed well during times of financial crisis. Next, start building up your cash reserves. Having cash on hand will give you the flexibility to take advantage of the buying opportunities that will arise when the market crashes. The key to surviving a market crash is to be able to buy when everyone else is selling, but you can only do that if you have cash on hand. And finally, create a strategy for buying quality stocks when the market hits bottom. The market will eventually recover, and when it does, it will present some of the best buying opportunities in years. Be ready to act quickly when that moment comes. The billionaires are already ahead of you. They've made their moves, and they're sitting on the sidelines, waiting for the market to crash so they can buy back in at a lower price. The question is, will you be ready when that moment arrives? The million-dollar question is, when will the market collapse, and what's the trigger? The truth is, no one can predict the exact timing of a market crash, but we can look at the signs to get a rough idea of when it might happen. Historically, the lag between peak insider selling and the start of a market crash is typically between 12 to 18 months. This means that if the pattern holds, we're looking at a potential market crash sometime between Q2 2025 and Q2 2026. But there are also other factors that could speed up the timeline. For one, the presidential election cycle plays a role. Markets tend to peak in the second or third year of a presidential term. In 2025, we'll be in the second year of a new president's term, and that's typically when volatility starts to pick up. The first year of a presidency is often marked by a lot of uncertainty, but it's the second year where the economic policies start to take effect, and that's when we start to see the cracks in the system. We're also in the midst of a corporate debt refinancing crisis. Over the next few years, more than $4.7 trillion in corporate bonds will mature. This massive pile of debt will need to be refinanced, but with interest rates rising, many companies won't be able to afford the higher costs of borrowing. This will lead to more defaults, which will put additional strain on the financial system. At the same time, the commercial real estate sector is collapsing. Office buildings, which were once seen as a reliable source of income, are now sitting empty. Remote work is here to stay, and companies are rethinking their office space needs. The result is a dramatic drop in property values. Buildings that were purchased at peak prices are now worth significantly less. As these loans come due, property owners will be forced to refinance, but with interest rates at record highs, many will be unable to do so. This could trigger a wave of defaults in the commercial real estate sector, which will further destabilize the market. And don't forget the spiraling U. S, government debt. With the national debt surpassing $36 trillion and interest payments consuming more than $1.2 trillion annually, the government's fiscal situation is unsustainable. Eventually, something will give. The government will either have to raise taxes, cut spending, or resort to printing more money. Any of these actions will have serious consequences for the economy, and they could trigger a financial crisis. Given all of this, it's not a matter of if a crash will happen, but when. The smart money, the billionaires, the insiders are already positioning themselves for the downturn. They're selling now, so they can buy back in at a much lower price when the market hits rock bottom. You need to do the same. But let's be clear, a market crash is not the end of the world. It's an inevitable part of the economic cycle. The key to surviving and thriving during a financial collapse is to take action now. You can't afford to wait until the crash happens and then try to react. By then, it will be too late. If you're not prepared, you'll be left holding the bag while the insiders are already sitting on cash, ready to buy back in at a fraction of the price. So, what should you do? First, reduce your equity exposure. Start selling off the overvalued stocks in your portfolio. Focus on quality companies that have a history of weathering economic storms. Move some of your assets into gold to hedge against inflation and economic instability, and most importantly, raise cash. You need to have cash on hand so you can take advantage of the buying opportunities that will arise when the market crashes. You also need to be mentally prepared for what's coming. The crash will be scary. The media will be filled with panic. Your friends and family will be freaking out. But you can't let fear dictate your decisions. You need to stay calm and focused. When the market crashes, that's when you buy. That's when you make your move and pick up the assets that have been beaten down to bargain prices. The reality is, the market will recover. It always does. And when it does, those who were prepared will come out on top. The billionaires who sold at the top will be buying back in at the bottom. They'll be the ones profiting when the market recovers. And you can do the same if you take action now. The best time to prepare for a market crash is before it happens. Don't wait until the market starts to decline to make your move. By then, it will be too late. You need to act now. Start reducing your stock exposure, raise cash, buy gold, and prepare yourself mentally for the challenges ahead. The insiders are already ahead of you. They're getting out now, so they can buy back in when the market crashes. The question is, will you be ready when that moment arrives?